Hi, this is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I hope you enjoyed yesterday's Q&A episode. Talked about lots of interesting questions. If you have any questions or feedback, send them to me at questions@investopoly.com.au. And so let's get into today's episode, and it's really about interest rates and inflation. And I thought it'd be interesting to really look at the facts. So there's a lot of people out there that will give you a lot of forecasts and what they think, including myself, by the way. If I'm asked, I'll tell you what I think, but what they think might happen with interest rates. But I thought it was really good just to take the opportunity, because there's a couple of facts that we should recognize at the moment that all sort of play into these forecasts, and I think give you a bit of background for assessing or making your own sort of assessment on both what people are telling you and then also, forming potentially your own view on interest rates as well. So there's really four key observations that I'd like to share with you today. What the RBA is telling us, what are the money markets pricing in, what does history tell us if we look back at data, and then what does the economic data tell us? And I think that there's different stories in all of those factual observations that will hopefully sort of bring it all together, or at least give you some context for, judging what other people are saying. So let's talk about the RBA first. So the RBA obviously produces its own forecasts, and it forecasts that inflation won't hit the middle of its target range of 2 to 3% until 2026. Now, most economists would agree that that's just too slow and risks inflation becoming entrenched. Whereas most economists would believe that you're better off to rip the Band-Aid. You're better off to hike interest rates, really quash inflation once and for all, because having persistently high inflation can do dramatic harm to consumers just from a cost of living perspective, and ultimately it would result then in higher interest rates for longer, and potentially the only way you can fix a persistent inflation situation is a recession, which we'll get to in the future when we look at what's happened back in history. So therefore, my observation then is, if the RBA believes its own forecasts and they don't want inflation to become entrenched, or at least take that risk, should they raise rates now, or should have they already raised rates higher in order to eliminate that risk or take that risk off the table? Now, the RBA has already faced a bit of criticism for maybe not hiking interest rates as much as other, or I would say all other, comparable developed economies like the US, UK, Europe and Canada. They've all raised their cash rates above 5%, whereas today Australia's peaked at 4.35% currently. So substantially below, I should say, almost 1% below most other developed economies. So the RBA is a bit of an outlier. Now, one of its rationales for not hiking as much could be that Australia has more variable rate mortgage borrowers, so we're more sensitive to interest rate increases than, for example, the US, where a lot of mortgages are on very long-term fixed rates. And that's true, right? So I acknowledge that. But RBA is still an outlier. And, that's only one element of interest rates. There's also the business element, access to credit, impact on expectations and asset pricing. Change in interest rates does have far-reaching consequences beyond, mum and dad mortgage holders. So I think it's reasonable then to assume that really the RBA's forecast doesn't match its current actions. Or alternatively, it might think that sticky inflation is less risky. Maybe they're not really worried about inflation becoming entrenched. Or maybe the RBA's trying to stop the market or prevent the market from thinking that the battle against inflation is won. So, for example, if it came out and forecast that it would be back within band of 6 months, maybe they worried that market expectations would get too out of control. And so maybe the RBA is kind of jawboning the market, trying to convince the market that, hey, the battle against inflation isn't won, by making sure their projections demonstrate that it could take a little bit more time to get inflation back into band. I don't know which one of those things it is. I'll share sort of where I'm leaning towards at the end of this episode. episode, but it just is interesting to acknowledge its forecasts are saying this one thing and its actions really aren't in line with its forecast, to be honest. Okay, so that's the RBA. Let's have a look at money markets, because money markets are, I think probably the best measure of the consensus of what everyone thinks, because really it's reflecting current prices, trading, all those sorts of things of really many, many institutions and very smart people and interest rate strategists and all those sorts of things. So the money market, when you look at the current yield curve, suggests that the cash rate will be 3.46% this time next year. So a reduction of 0.89%, almost a full 1% reduction. So that's pretty significant, and again, a little bit out of line with the RBA. Now, of course, the RBA is in control of interest rates, and so it would be reasonable for all of us, both of us, to ask ourselves, well, why would the money market be kind of ignoring what the RBA is saying? Because the RBA is saying, well, inflation's not going to get back into band until 26, so can you really expect them to cut interest rates by 1% over the next 12-ish months? Well, we only have to look back to 2021 when it's been well documented. The governor at the time, Philip Lowe, said that rates were very likely to stay at record lows until at least 2024. That's verbatim exactly what he said. Now, at the time when I looked at money markets had a different view. They were pricing in about 1.2% of hikes between late 21 and mid 23. And at the time, I was thinking, I was a bit puzzled, like how could, you got the RBA saying, no, we're not hiking rates till 24. And then you got the money market saying, no, they're going to hike by 1.2%. There was a kind of disconnect between that. And I thought, well, hang on, Philip Lowe is the one in control, right? So if he's the one in control, that's the one we should be listening to. What the hell is the money market doing? It doesn't make a lot of sense. Now, the money market ended up being more right than Philip Lowe, because by May 23, the cash rate had actually risen to 3.85%. Remember, the market was pricing 1.2. We actually got 3.8 odd percent hikes, and it was a lot higher than what anyone could have expected. So I think the key learning that I enjoyed over that period of time was don't disregard the market. Don't bet against the market. You'd be silly to sort of do that. But also, it's not a perfect predictor. Whilst it's not a perfect predictor, it's a pretty good indicator, typically, if not from quantum, but from direction. So, we might not get a full percent cut over the next year, but the message really is from money markets is that rates won't go higher. They'll start trending lower over time. To what quantum, no one really knows, but that's kind of just the general theme. The other thing that everyone learnt during that period, not only just in Australia, but really relating to central banks around the world, is that you can no longer really trust what they say. They're just another voice in the whole thing. They're just another thing that you need to consider, right? So, like I said, maybe the RBA's forecasts are suggesting that to try and curtail the market, cool the market in terms of their expectations of how quickly inflation might come back into band. And I don't completely discount that as a potential possibility as well. Okay, the next thing I want to do is have a look at history, because there's been a little bit written about this recently. So last year I highlighted some research that a US firm Research Affiliates put together, and they found that 70% of the time that inflation would peak above 8%, I think it was, or at least wherever we were, 70% of the time, inflation will come down and then reaccelerate. So it will sort of tick back up. And interestingly enough, Coolabah Capital and Chris Joy from Coolabah Capital wrote about this in the Australian Financial Review recently. If you want to see the article, I've got the link on the blog on the website, so you can have a look at that. And his team examined the last 75 years in the US and found that on 16 occasions where the Fed Reserve had to raise interest rates to tackle inflation, to sort of cool the market, 15 out of 16 of those times, it either led to either a recession or saw inflation re-accelerate. So only one time out of 16, they actually achieved what we'll call immaculate disinflation, which means that we've had a soft landing, that they've been able to make sure the economy is still relatively healthy, but cool inflation at the same time. So given all this data and research, I don't think we can ignore the possibility that whilst we might see interest rates trend down next year, they might only be a temporary movement. In fact, I would say that it should be our base case, based on that historical data, that there's a high probability that inflation will re-emerge, will trend upwards again, and that any interest rate cuts next year might be temporary. That maybe in 26 they'll need to hike interest rates again if inflation isn't cooling or isn't moving in the right direction. And that data actually suggests that the only way to solve the inflation problem, if that does occur, the only way to solve the inflation problem permanently is to go into an economic recession. Now, it doesn't have to be a deep economic recession, so I'm not predicting Armageddon, but maybe we've got to see a much stronger rise in unemployment rates, which is a good segue into sort of my next segment of this episode, which is looking at the data. So remember, what I'm trying to do is focus on the facts here rather than the rhetoric and the forecasts to, again, give you some background to the forecasts that you might listen to or come across. Okay, so let's look at the CPI data. If you look at the last quarter, so the June quarter CPI, the inflation, the categories where inflation was above 3%, so above the RBA's band and therefore contributing to, the higher than average or higher than band inflation, included food, rents, healthcare, clothing, footwear and insurance. They're the sort of key categories. And really, the explanation is that the significant proportion of persistent inflation is found in what's called non-tradable services. Non-tradable services are services that can't be enjoyed from a location other than when they're provided. So things like utilities and medical services and insurances, they're non-tradable services. And a lot of the commentary says this is largely due to wage costs and a very tight labour market. And so when you look at then, okay, what is driving this tightness in the economy, all the signs point to government spending. Government spending has contributed a substantial amount to the tight labour market. In fact, Chris Joy highlights that over the past year, public sector job growth has accounted for 50% of total job growth, despite the public sector employing 31% of Australians. So even though they employ 31% of Australians, they've contributed 50% of that job growth, and that's a problem. If you have a look at government spending over the last 5 years, it's increased by 25%. So, that certainly adds to inflation, doesn't detract from inflation. Notwithstanding then, we've got policies, I would argue, not great policies for the time. The stage 3 tax cuts that occurred that came into force in 1 July this year. And then you've got the energy rebate that wasn't means tested. I think the stage 3 tax cuts should have been delayed till next year, and the energy rebate should definitely have been means tested. And also Westpac Economics has agreed with Joy, and also last week we saw the GDP data released, and it shows that all the growth is coming from the public sector. All the growth in the economic growth, the stimulus is coming from public sector spending, not from the private sector. In fact, private sector is weak from GDP growth perspective and going backwards. It is really all this government spending that's really exacerbating the inflation situation. The other challenge with monetary policy, that is using interest rates to cool inflation, is that it is a bit of a blunt tool, and I think most people acknowledge that. Say, for example, baby boomers, who make up about 27-28% of Australia's adult population, are less likely to be in debt. They probably don't have mortgages, certainly not home loans typically, and higher interest rates actually help them, particularly if they're retired. It actually increases their returns, higher interest rates do. So it has the opposite effect of what higher interest rates are supposed to do, which is kind of cool the market. And based on CBA's data, baby boomers actually over the last 12 months increased their spend on dining out by 7% and travel by 10%. So it sort of reflects in those numbers as well. And that can be, that can be challenging, I think, for people that aren't in that category, recognizing that kind of they're doing all the heavy lifting. Those people with large mortgages or people on lower incomes are understandably feeling the pain from higher interest rates, and they can only cut back so much, right? Once you've cut back every discretionary element, what else can you do to contribute towards, cooling inflation? And you've got then another cohort of Australians, nearly a third of Australians out there that aren't impacted by higher interest rates, negatively impacted by higher interest rates. So then let's bring this all together then. We've got the RBA that's predicting one thing but doing something else. We've got the money market that's predicting maybe about 1% of interest rate cuts over the next 12-ish months. But I think we don't necessarily need to hang our hat on the actual number, but maybe just the trend. So the trend is interest rates are coming down. We've got all the data telling us that, the inflation's been stimulated significantly by government spending. So you've got the RBA doing one thing and, the government doing something that's counteracting what the RBA is doing. And perhaps The answer is Australia needs some tax reform, which I wrote about last year. Of course, the link's on the blog on the website. And, maybe something, for example, of having a luxury rate of GST on luxury goods might help the effectiveness of monetary policy. The problem, though, is with implementing tax reforms to help with these sorts of things, they often take years, if not decades, and a government with a long-term view, which is obviously hard to find. And if we look back at history, because, I'm always kind of evidence-based, we've got to acknowledge that achieving a soft economic landing is going to be difficult, not only here in Australia, but also in the US, really anywhere in any economy, really. So we've got to cool our expectations. I think that, if our expectations are great, we've battled inflation, we've won that battle, and now interest rates are going to come down for the foreseeable future, I think I would cool those expectations a little bit and leave room for the possibility actually interest rates might end up ticking back up in the future, and we should include that potential in our own financial decision making and our own financial plans. And of course, the result of that could then be higher interest rates, an economic slowdown, so technical recession. Again, doesn't have to be a deep one, but a technical one all the same. And we should also keep that in the back of our mind as a potential outcome as well. My personal view is, I think we probably will see the RBA start cutting interest rates next year, but my concern is how long will those lower interest rates persist for? It will be a very interesting time to see how this all plays out, but I think it's always good to some degree plan for the worst, expect the worst, and hope for the best. Okay, let's get into some questions, and my first question is from Ross. Ross writes, I have an accumulation account with Australian Super, and after listening to your transparency issues with Australian Super, I did some digging and found the following webpage which he provided me. What do you reckon of this level of disclosure? I thought it was pretty decent. Enjoy your content. Thanks very much, Ross. I did have a look at the webpage you sent me, and just for those that, just as a reminder, my concern was that the way industry super funds invest is very opaque, and I think we're actually seeing some of that play out a little bit with the investigation with the CMFEU, nationally, and its linkages with CBUS, the industry super fund there, and the members that have been on that board, and the arrangements that they have with the CMFEU. I think we're seeing all that opaqueness kind of play out a little bit, and maybe that should give you a bit of a flavour. I'm not suggesting, not throwing stones or making any accusations. I'm just saying problems tend to live in the dark, whereas transparency, if you've got nothing to hide, then you've got no reason not to be fully transparent. Anyway, I had a look at the disclosures on the website. All it does really is list the investments that they hold. It doesn't really give you much information. Some of them give you ranges. So we hold this investment somewhere between 300 million and 1.5 billion, for example. That's a huge range. And that's all it gives you. So look, as a financial advisor. The first thing I should say is that one of the counter arguments to publishing this information is no one's going to care. No one's going to really look at it. And I acknowledge the average punter, the average superannuation investor isn't going to trawl through pages and pages of reports. But certainly a research house will, and we pay a research house, Lonsec, to do research on our behalf, because obviously we're otherwise spending all our time doing that sort of research. Financial advisors will, and certainly the media will write about it as well. So the transparency element doesn't necessarily have to go to the end user. It just needs to go out into the market. And so what would I like to see? Well, I listed a couple of suggestions just thinking about it. I'm not suggesting this is an exhaustive list, nor is it something that I've sat down and thought about for an extended period of time. But for example, the industry funds have money that they manage in-house and money that they manage externally. So externally, they'll give investment mandates to third-party fund managers to manage a particular portfolio or money, and then the internally managed money, they'll build their own investment team. And I've written about this previously about, some of the risks of internalizing. They're trying to obviously save money to reduce fees, but, the challenge then is attracting talent and how do you manage that performance and all those sorts of things. So what I would like to know is I'd like them to report the mandates that they've awarded to external managers and the mandates they've terminated, and the reasons why, and just more commentary around who they're using, what is the individual performance, how do they assess that individual performance, and then for the ones that they've terminated, was it due to performance, and if so, how long have they been underperforming? That just a little bit more commentary around those sorts of things. I think per investment, we would certainly want to know, the value of that investment, how it's been valued, and some commentary around the valuation, particularly particularly unlisted assets. So if they're citing comparable sales, if it's an unlisted tech company, for example, and there's something in the paper last year about Canva, the Australian tech company, some of the super funds hold an interest in, and there was some commentary, I think it was Host Plus held a certain tranche, and so did a private equity firm in the US. The private equity firm wrote it down by 30% or something, and Host Plus didn't. So, let's cite those sort of comparable transactions to create that transparency. The underlying fundamentals of the investment, so if it's infrastructure, the amount of gearing, the amount of contracted revenue, earnings per share or per unit, those sorts of details. Again, I've mentioned their process for reviewing performance of external managers. So what are the managers that they're continuing to work with, and why do they continue to work with them? And then the performance of internal managers, so their internal investment teams. If they're running an index portfolio, for example, how closely did they track the index? And for other portfolios that they're running internally, what are their performance benchmarks there as well? So how well do they do compared to external managers and other industry super funds and so forth? We want to make sure that if we're going to internalize that investment management, that actually it's not only yielding some cost benefits, but actually we're not taking a haircut in terms of performance either. And I've got to say, knowing what Vanguard does, Vanguard's the second largest global fund manager, and that it has trading desks around the world to make sure that it tracks indexes, to the nth degree, to minimize the trading cost of an index strategy, goes to extraordinary lengths to do that. That's probably a podcast for another day. The industry super funds couldn't do that. They couldn't replicate. So they're going to do worse than Vanguard. For instance, let's find out how much worse they're doing compared to Vanguard. And then some reporting on new investments. So if they've gone and put $1 billion or a couple of $1 billion in another, unlisted investment, let's get some information on that. Just like when a listed company makes a material acquisition, they need to report it to the market, and they need to give the market an idea of, what they've invested in, the price they've paid, all those sorts of things. Now, the industry funds will cite commercial confidentiality for some of these things. And I get that, some of these things are commercially confidential, but you could certainly probably report them after the fact without breaching too much confidentiality, I would have thought. But more transparency around these sorts of things. I said there's a lot of information there, but I think you would want, as a superannuation investor, the requirement for funds to put that information out, because it does create a transparency process, even if no one actually looks at it. Just the mere fact that someone has to report these things tends to sort of keep them honest, if you like. And then as an advisor, to recommend you should put your money into Uni Super or Australian Super or whatever. For me to make that recommendation, I need to be confident and comfortable with, those underlying investments. That's why I've tended to skew towards Uni Super, just because it has far fewer unlisted investments. So they're all sort of market traded, gives you more transparency. So Ross, thanks for that information. And, it was good sort of practical, I guess, example of, some of the things that they're doing and that I think they could probably do better as an industry. Okay, next question, probably maybe the last one, is from Dina, a really interesting one, in fact. Dina says, I've learned a lot from your podcast. Enjoy the Q&A episodes. So thanks so much for that. Dina says, I bought myself a unit in 2012. The purchase price was $610,000. In 2016, my now husband and I purchased a family home, and I borrowed $150,000 against the equity in the unit towards the deposit for that property. This brought the loan balance to $700,000, which comprises of $550 to the original purchase and another $150 to the home. So some of it's deductible and some of it's non-tax deductible. The rent's $900 a week and therefore positively geared. The unit's worth approximately $1.4 million now, so that's a pretty good outcome over, 12 years? Pretty reasonable outcome. Would it be worthwhile for me to sell a portion of the property to my husband so that we have a higher tax deductible loan? We're both in the top tax bracket. The proceeds could then be used towards the loan repaying our home loan. We want to retire in 12 years at age 60. So based on my calculations, if we keep paying the minimum, we'd still owe $600,000 against the house. I would say that's the home loan. A few considerations including borrowing capacity against the property value, CGT, stamp duty. Is there any way this would balance out and we would be better off? So just to summarize, great question, Dina. And just to summarize, are we better off transferring some of the ownership? So the husband would then borrow to buy 50% of the investment unit. Dina could then use that 50% proceeds that she's received from her husband and repay her home loan, so reduce that balance. Therefore, the husband then has this new investment loan, which they can get a tax deduction for, and the home loan balance is reduced. The only difference is then you have to pay capital gains tax, so that's an out-of-pocket expense. So my first observation, Dina, is split the loan out. That's the first thing. Never mix purposes in one loan. I don't know if you've done that, by the way. It's not clear from your question. But if you do have one $700,000 loan, I think actually you do, because you mentioned the loan actually is no longer 700, it's 615. So it must be on P&I repayments, which means that 21.4% of the loan is non-tax deductible. So I would split that 615 loan into two loans, one of 131 that's going to be your non-deductible portion, and one that's going to be 484, which is your tax deductible portion. You have to apportion the loan balance like you have, and that's the problem with mixing, is that you can't just repay the home loan portion. You've got to repay the pro rata on an even basis. So if you have a home and investment purpose, make sure they're in two separate loan accounts, and your bank should be able to do that relatively easy, split it into two accounts. Okay, so based on the numbers, I worked out that there's going to be two costs associated with potentially selling 50% to your husband. There's going to be capital gains tax and there's going to be stamp duty. I estimated the capital gains tax liability, if you're on the highest marginal tax rate, is about $93,000. I estimate that selling 50% of an asset that's worth 1.4, so 700,000 of value, is going to attract around $26,500 in stamp duty. So let's say the rough total cost of making that transfer is going to be $120,000. Now you can, or your husband can, borrow the stamp duty portion, but you actually have to pay the CGT amount in cash. So that's going to be an outlay. So as a result of your husband paying you $700,000 for 50% of your property, you'll receive the $700,000. You'll pay the $93,000 in capital gains tax, which will give you $607,000 that you can use to repay your home loan. So essentially the saving to you is that you've essentially converted $607,000 from what is currently not tax deductible to being tax deductible, albeit in your husband's personal name. And so at 6% per annum in terms of long-term interest rate, just roughly, I'm being conservative, on the low side, but use somewhere between 6 and 7%. At 6%, that's going to save you about $17,000 in tax. So the cost is $120,000, although you can borrow the stamp duty. The benefit is $17,000 a year. So based on my calculations, I calculated based on the time value of money that it would take you 10 years to be better off, because you've got to pay the $93,000 at least today. That's an out-of-pocket expense. And then hopefully what you're doing is hoping over the next number of years you get this tax benefit. And of course, a benefit today or a cost today is more costly to me than a benefit if I've got to wait for it in 10 years' time. So it takes you about 10 years to become better off. And over the next 12 years, which is your time to retirement, you're about $30,000 better off in today's dollars from changing the gearing. So I don't think I would do it, because a lot could change over the next 10 years that may mean that it doesn't work out. You might end up selling that property in the next 10 years, for instance, and then it's all being kind of wasteful and you've been worse off. The payback period just isn't beneficial. I'd keep the property for another 12 years and then sell it if you need to repay your home loan. I'm sure, at least based on its growth to date, I'd imagine it's going to give you more than enough equity to be able to repay your home loans. So that shouldn't be too bad. And I would say that, I come across very, very limited circumstances where changing the ownership of a property is actually worthwhile. Normally, the capital gains tax and stamp duty consequences of doing that is cost prohibitive. And so that's why we really want to think very deeply about, how we own a property, how we structure the ownership of a property when we first buy it, because we've got to live with that ownership structure for the entire time we own that asset. But great question, Dina. I just thought I'd take everyone through the figures in terms of our approach in working out, is it worthwhile, is it not worthwhile, to give people a little bit of context. Okay, just a reminder, we've got that 97-point health checklist that you can download, links in the show notes, of course. And until next week, bye for now.